Welcome to the Plan Solutions Incorporated podcast, where we give facts and insight on the latest happenings in the world of economics, financial markets, and personal finance. Plan Solutions provides advice on a variety of financial topics, including investment management, tax preparation and planning, and retirement planning. Chase has 25 years of experience in the financial industry, holds a certified financial planner and chartered financial analyst designations, and has earned a master's degree in taxation and a doctorate in business administration. Chase has a passion for helping clients down the path toward their financial goals. And I'm Jason LaChance, and on this episode, we're going to discuss business margins get squeezed. We're going to take a look at Senior Loan Officer Survey and the significance of that. As well, motor vehicle sales remain strong, and then we'll venture on over to the Plan Solutions Incorporated office bulletin board. Mr. Armour, good sir, how are you?
Doing well. Yeah. I mean, we're recording this early, but because, we normally record right as I would be coming back from vacation. So hopefully I'm feeling nice and relaxed, but I'm sure when this comes out, I'm going to be digging out, right? A lot of work to get caught back up.
Yes, sir. All right, let's dive into business margins get squeezed. Consumer inflation has been in the headlines recently. We've been discussing it. We've talked around cost push inflation. That's really caused these, prices to increase just due to higher costs for oil and its related products and so on. So where do we want to dig in around this? I mean, commodity prices going up, consumer prices, the war with Iran. It's a lot to unpack.
Yeah. Well, we've kind of had this balancing act, right, between those risks, right, the cost push inflation, oil supply shortages, the war, and then on the other hand, you've had first quarter earnings season was really strong, which we've discussed as well, with the majority of companies reporting better than expected results. But of course, first quarter earnings season, it's backward looking, right? It's looking at a period before a lot of these risks emerged. And, the question is, what are we likely to see going forward? Are businesses going to be squeezed? Are their margins going to be squeezed by these higher commodity prices? So what we did is we pulled out a chart that, we use constantly, but isn't always worth commenting on, because if it's just kind of normal, things are normal. But when you see a chart that, shows some fluctuation, it can be pretty interesting. So one of the ways to get a real rough gauge of business profit margins or business profitability is to take the consumer price index, which measures consumer inflation, right? What we're paying when we go to retailers and so on, with business prices, or in other words, the producer price index, the PPI. And when you chart the two, you kind of get these rough spreads. You get periods where producer prices may be increasing at a faster pace than consumer prices. Mm-hmm. And that means businesses are paying more for inputs, but they're not able to pass those cost increases along to consumers, or maybe they're just choosing not to. And then you see other periods where, maybe consumer prices are moderating, but producer prices are flat or even falling, right? So producers are, getting a better deal on what they're paying, but still able to charge similar prices to consumers. And that's periods where that rough business margin, spread is widening, or in other words, signaling greater potential profitability. And the reason this is interesting now is we have seen this uptick in consumer prices recently, and that's what a lot of people have talked about. But over the last 2 months, we've seen a much larger increase in producer prices. So really, it's a kind of a situation similar to 2022, when we had the high inflation, and people were complaining about inflation, saying, "Oh, it's greedy businesses, passing on, forcing higher prices." But really, the businesses were eating a fair amount of the inflation, right? They were incurring much higher costs and only passing a portion of that on to consumers. And at least so far, we seem to be seeing a similar dynamic where producer prices are going up faster. They're only passing on a smaller portion of that to consumers. And what that's doing is it's causing that rough gauge of business profit margins to contract a bit.
Yeah, I mean, because ideally, we want a good divide between the CPI and the PPI, as far as that's an indicator of a healthy economy, I would think, from my understanding.
Exactly. Yeah. I mean, we want, low inflation, right? Price stability. It makes everything planning so much easier, not just for us as consumers when, we're doing our shopping or figuring out what our longer term financial plans may be, but it also makes it a lot easier for businesses to know that your costs aren't going to go up. And all of a sudden reduce the profit margins that you're able to make on some of the goods that you may be in contract for, that you're going to deliver or just don't want to shock your customers with steep price increases over a short time period.
Yeah. So if we take a look in the past, as far as a chart that is here on the personal financial review, it states that there's three periods where the rough profit margin gauged narrow. And what really kind of is that an indicator of when that gap was really narrowed?
Yeah, well, one of them clearly on the chart was 2008, right? The financial crisis. We saw producer prices moving up faster than consumer prices before, you finally had an adjustment, kind of a deflationary period, believe it or not, because of the financial crisis. And then you see it again where it really narrowed in 2022, as we discussed, right? That the higher inflation was hitting businesses much harder than individual consumers. And then over time, those business input prices kind of normalized, and consumer prices continued to increase at a slower pace, and those margins spread back out. And then we're seeing a bit of that type of pressure so far now.
Yeah. So what is this really kind of, indicating? We've been talking a lot about interest rates lately and everything as we continue to move forward. But as we started at the top of this topic, this is backwards looking. So it's not necessarily going to give the overall picture of what the result we're going to get, but it does dictate kind of towards a potential trend.
Yeah, the shift that we're seeing is the thing that says we should be paying attention to it, right? I mean, right now the business rough profit margin is still pretty healthy, but it has narrowed. It was looking very good, and it looks less good today. And we've seen this strong shift just really over the last 2 months of reported data. So basically March and April. So the question is, will this trend continue? If it does, we could really see those business margins start to get squeezed based on past indicators. That's when we would definitely be concerned that the second quarter earnings, maybe they don't dip, but maybe we don't see the strong growth that we've seen in the last 3 quarters. And stocks, when you price stocks, you're not just looking at current earnings, but you're looking at the current earnings and the expected earnings growth. And so even a slowdown in the expected earnings growth, could cause stock prices to stagnate or even dip, depending.
Yeah, and to touch again on how this is backwards looking, it's a collective of data. Would it be safe to say that quite oftentimes, according to this graph, how it's shown in the past, that as you stated, the businesses have not yet started to pass on the full impact of higher prices for them and what that can mean for the cost for consumers?
Exactly. That could be the alternate scenario, right? So maybe businesses don't feel that they can pass on the full price increases. Maybe they think it's going to be temporary, and you don't want to upset existing consumers or cause them to, find substitutions, go to a competitor, or just do without, right? Whatever the product is that you sell. I mean, that can happen if you raise prices, too high too quickly. And then it can be very expensive. Customer acquisition costs to try and get those consumers back or replace them can be very expensive. So it may be this is a sign that businesses think this price shock will be temporary. It may be that they feel that they can't increase prices that quickly, so they're kind of taking a longer term view, right? That they'll continue to try to pass this on, but over a longer time period. Or it may be that just in the short term, they've been willing to eat it. But, if it gets to the point where they're saying this is too much, then they have to pass it on to consumers. And we see that higher producer price index inflation that's been a much sharper increase. See that reflected in consumer prices, which could create some real challenges.
Yeah, yeah, that's the inflationary pressure, right?
Yeah, exactly. And we thought we were through the inflationary period. Inflation got as low as 2.4% in January. It was looking a lot better, but here we are with consumer inflation at 3.3%. And if this is charted as any indicator, at least in the short term, that may very well not be the peak.
Yes, sir. All right. Well, let's jump on to our next topic here. Senior Loan Officer Survey. We have touched on this in the past because every quarter the Federal Reserve conducts a survey of senior loan officers, highest ranking loan officers in key lending institutions. And what really is this survey designed to do? What it's designed to gauge, and what were some of the results of the survey that took place in April?
Yeah, I mean, strong, well-functioning lending markets are important to any economy, but really important to modern economy and have a big impact on the pace of economic growth. So this survey is designed to go to the highest ranking loan officers and basically ask them about their financial institution's willingness to make loans, whether those loans are being offered at attractive rates and underwriting standards, right? Are they making it more difficult to qualify, or are they making it easier to qualify? How much risk are they willing to take from that standpoint? And then also ask about consumer demand, right? What are they seeing in terms of people requesting loans? And all three of those pieces kind of give you an idea of the lending environment. Is it loosening? Is it becoming more accommodative, and therefore more people may be able to borrow and at good rates and use that money hopefully productively to create economic growth? Or are financial institutions becoming more risk averse, kind of hunkering down, maybe preparing for a recession or some type of economic slowdown or more challenging environment?
Yeah, the survey indicated that was done for in April that it's, as you said, a healthy lending environment. However, there were some minor differences which may indicate changes to the financial environment.
Yeah, I think maybe with the war in Iran and some of the associated increases in key commodity prices, right? A little bit higher inflation, which we've touched on. You did start to see some slight adjustments. Now, because the Fed does this quarterly, it's not really a high frequency type indicator, so it can be difficult. And you might see a very short-term adjustment, and then you have to kind of read into it. Okay, is this a change in trend? You won't find out for another 3 months. But what was interesting is the commercial loan environment. Basically, respondents reported that they were tightening standards, not by a lot, but making it somewhat more difficult for businesses to qualify for those loans. But they were lowering spreads, so basically, lowering the interest rates that they're charging over their compared to their cost of borrowing. So they're being more selective on who they will lend to, probably stressing businesses with higher credit worthiness. But for those that qualify, are actually getting a little bit better deal, or those loans are a bit more attractive. So that was interesting to see kind of a shift there. Commercial real estate loans were little changed except for construction and development loans, which reported tighter standards. And as well as reduced demand for those loans. So,
Hmm.
we keep thinking, when are we going to see the real estate market really pick back up, right? Well, I mean, obviously, land and construction loans is kind of the first stage of that, right? And we're not seeing very much strength in the pipeline. And then consumer loans. It's interesting that demand has decreased, and that may partly be because banks have slightly loosened standards and their willingness to make those loans, but we're just not seeing as much demand. So again, it might be an early sign of a little bit of weakness among consumers, maybe some concerns about their stability of their future income, future cash flows to be able to pay back a loan. So even though the banks are making those a little bit more attractive, consumers are, for the most part, less inclined to borrow.
Yeah, I think it's all really interesting for sure. I had a conversation with a friend of mine about real estate in the Los Angeles area where he is at, and he's like, "Yeah, nothing is moving here. There's just not the demand for it." So it's really interesting. But I think the consumer loan aspect plays really interestingly into our next topic. So I just want to segue right to it. Motor vehicle sales remain strong, which I really, I always read this in chronological order whenever I get it. So I didn't expect that to follow the consumer loan demand having decreased, but motor vehicle sales remain strong, which, correct me if I'm wrong, please, but that tends to be one of the biggest area of consumer loans.
Yes, yes, exactly. And it's a major industry, right? Two of the major industries that we look at as real bellwethers of the pace of economic growth is the home building industry and motor vehicles. Because you don't just have those big companies, the manufacturers that are, or the home builders, but you have all of the suppliers, and their supply chains run really deep and really broad. And then, of course, you have, like, in the case of motor vehicles, you have the dealer network, right, which is like in every town, and has an impact on the spending and the overall economic growth rate there. So we do focus on these two, and that is kind of one of the surprising things that you're seeing is that motor vehicle sales, but appear to be strong. What we tend to look at as a gauge of the motor vehicle industry is data that's released by the Federal Reserve Bank, which measures the total value of shipments of motor vehicles and parts.
Mm.
So includes parts departments as well. But uh, over the past year, it's increased 9.5%, which definitely indicates a strong market. And in fact, the monthly total value of shipped motor vehicles and parts exceeded 72 billion for the month, which is an all-time high. So I think it indicates that the motor vehicle industry, despite some of the negative headlines and things that I've seen, is still in quite good shape, despite the higher interest rates and rising inflation and some of the things that you would think would maybe trip them up, or I think could say in the past we've seen trip up the pace of vehicle sales and the value of monthly shipments.
Yeah. Speculation maybe on why this is that motor vehicles, sales just tend to remain strong. Is it maybe because there was a dip a few years back, people are just needing to get that upgrade to a new vehicle. Retail, the dealers are making it more enticing. I mean, any further indications around that?
Yeah, I think there has been some promotional type things, but I think it's pretty few and far between, right? You haven't seen the big promotional offers that a lot of times indicate that dealers are struggling to move vehicles. The strong performance. I think you could argue that the market was undersupplied, right, for a while, and so now it's still maybe playing catch up to a somewhat probably small but somewhat degree. It could be the rising gas prices, right? I mean, how many people have talked about I need a more fuel efficient car, and so kind of people with longer commutes trading in for something that's more fuel efficient, or it could be just a sign of, as we've talked about, strong job market, strong corporate earnings, a lot of the positives that we really rode into 2026 on that, we kind of hit a rough patch there in March or April, but maybe it hasn't affected every industry equally.
Yeah, yeah, interesting one to continue to keep an eye on for sure. All right, well, let's jump on over to the Plan Solutions Incorporated office bulletin board. We've got one item pinned up there this week. What is it, good sir?
Yeah, so we took some time out of our normal busy week, and we had another 2-day business development session with our business consultant, Lori Frazier. So Lori was pretty high up in a number of different companies. Has been friends with Katie for years, and kind of her quasi retirement job is taking all of those knowledge and skills and other things that she's explored during her business career, and taking it to other businesses, and helping, to in some cases address challenges, but in other cases like ours, really just help give us more tools, right, to communicate better, to coordinate on different complex tasks, to as a leader, look down the road into different directions that the industry may be changing, or how client preferences may change. So I'd say it was a really productive 2 days. The morning of day one was really just her and I reviewing a leadership circle assessment that I did, very similar to kind of a 360 leadership, and looking at kind of gaps in leadership skills, places where I can develop and maybe become a stronger leader. And then that was followed by an afternoon session with the whole Plan Solutions leadership team. So myself, Daryl, Joel, Shannon, and Katie, and really reviewing progress on some key initiatives that we'd outlined some while back, and saying, okay, how are these going? What are the next steps? What can we learn from the progress so far? And then the second day, really the whole day was the whole office, and we focused on naming and the continuity of Plan Solutions core values, and how to really make sure we hold on to those, that core culture that we think is so important, but while at the same time making room for growth and change, right? The bringing on Matt and Carter, and obviously, the adjustments can be uncomfortable and it can shake things up. So we want to hold on to the good while, continuing to be adding to it.
Yes, sir. Absolutely. Well, anything else you want to add before we wrap up this edition of the Plan Solutions Incorporated podcast?
No, I think we covered it. It's kind of interesting. I mean, here we're recording this, and it's going to come out in like 3 weeks, right? with the way the scheduling worked. And so, but I wanted to make sure we kept a, consistent cycle with getting the newsletter out, getting the podcast out. So, had to plan ahead, before heading out on vacation, which always makes you a little nervous, because you think, there's going to be some big business news or something that's going to come out, and people are going to say, why didn't they cover that? Right. Well, obviously, it must have been something that we couldn't anticipate, but but hopefully, no big business or market changes for the next week or so, so that I'm not stressing too much while I'm on vacation.
Yes, sir. Absolutely. Well, we thank you for listening to Plan Solutions Incorporated podcast. If it's your first time, please hit that subscribe button on whatever platform you're on, Apple Podcasts, Spotify. We'd appreciate a rating and a review there. And please share it with someone else that you think will get value out of it. The podcast continues to grow, and we know that's because it's because of you, and we don't do any external advertising, so it's word of mouth. So thank you for sharing it. And if you want to follow along on our YouTube channel, youtube.com/@plansolutions, you can get a visual form of the podcast that includes the personal financial review on screen, which is the written content we discuss. And it's easy to subscribe to as well, simply by sending Katie an email. That's KATIE @plansolutions.com. Email her and get subscribed today.
The views and opinions expressed in this podcast should not be construed as an offer to buy or sell any securities. The information may not be current, and Plan Solutions has no obligation to provide an updates or changes. Plan Solutions does not make any representation or warranty as to the accuracy or completeness of the statements or any information contained in this podcast, or any liability therefore, including in respect of direct, indirect, or consequential loss or damage, is expressly disclaimed. Plan Solutions is not providing any financial, economic, legal, accounting, or tax advice in this podcast. In addition, the receipt of this podcast by any listener is not to be taken as constituting the giving of investment advice by any Plan Solutions associate or individual to that listener, nor to constitute such person a client of Plan Solutions. Any reference to a specific company or security does not constitute a recommendation to buy, sell, hold, or directly invest in the company or its securities. Market indexes are unmanaged and cannot be invested in directly. All price references and market forecasts correspond to the date of this podcast.
Plan Solutions is a registered investment advisory firm.